So we're picking up the topic from the last poll before took holiday break, which was systematic overlays. As usual, it's an open forum, and raise your hand if you would like to speak, and I will invite you to the stage. As always, we start with a disclaimer. This is not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek Wong and other speakers have done their best to ensure accurate information, regardless of anything to the contrary. Nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your local jurisdiction. So I guess I'll kick off because this has come up on my side a bit because it is something that I'm familiar with and do use. Although I don't remember what episode of Top Traders Unplugged it was because I've been trying to catch up on the episodes that I've been missing. But someone had mentioned, or it came up, maybe it was in the roundtable, stepping in on your system to reduce risk at certain times when risk is very high. I think that is a example of an overlay, but a discretionary one. And then we can counter that by having certain risk metrics whereby we are able to um, reduce our risk or reduce our exposures based on certain risk metrics, make that systematic. And then that would be a systematic overlay versus like a discretionary risk overlay. I think that's a good example. Some of the other examples I think that have come up in our previous conversations are using a macro overlay such that you are taking potentially macro factors and then combining them together to generate you some signal. And then this is going to influence how you are putting on positions. Maybe it's influencing your position sizes, maybe it's influencing what type of strategies you want to implement on top of that. um, and then classically, I think another example of this is putting options overlays over your positions. And in that case, I'll use the equity example because I want to keep this broadly applicable to all asset classes. A covered call is an overlay, a put hedge is an overlay, a collar is an overlay. And we have talked about one of the weaknesses of being a trend follower is um, not having that short-term strategy. So picking up a long vol component or a options component that would cover that could be considered an overlay because I'm assuming that the allocation to that is going to be significantly less than your total allocation to whatever your main strategy is. And so I think that gives a broad overview that's broadly applicable to all of the different types of overlays that have come up in this clubhouse previously, or in some of the podcasts that I think we're all familiar with. I will open it up to the floor and just let me know to raise your hand, and I'll bring you up.
Hi, everybody. Hi, Derek. Look, I just wanted to wish everyone a happy new year. Hope they had a great new year. I'm probably not in a position to actually start a conversation on this one at the moment, so I might just sit back and just hear what others have to say. But thanks, Derek, for this session.
Okay, well, I'll keep the dead air. I feel like a late night talk show DJ sometimes when I do these clubhouses to make sure there's no dead air. So if I step on you when you're talking, but based on Richard's comment, I do think it's something that's quite unique. And when you consider being a systematic trader, and you consider what we think of as signals, and backtest and sample size and all of this. I know we want to follow those golden golden rules, it does reduce that. But um, the interesting aspect is that you can use something that's weaker than you would put into a system in an overlay, and it can still derive benefit. I think in my research, that was what I found to be quite interesting. Was you may not be able to have an overlay be purely profitable on its own, although or maybe generally profitable. It might be one of those things where maybe it's break even or slightly profitable or something like that, or maybe even could be negative. But when you add it to the mix of what you're trading or the systems that you have, it ends up making the whole thing better, which I think broadly speaking is something that we're all looking to do. And in my also in kind of my experience, it allows you to dabble in things that you might not be that proficient in. Knowing that you're just going to have some kind of overlay or some idea, you can kind of how do you say, scavenge something that may have been a failure in the strategy side, but you might find applicability for it as an overlay, and not a direct strategy. So it allows you to be a lot more efficient in your research. And I'm always trying to find ways to maximize the research effort and see how these kind of Legos fit together. Going into the different ways to execute against it and how informative it is, again, kind of goes into what your research is. And then because it's separate, you are clearly able to see what's the deficit, from your overall like kind of sample size. It doesn't necessarily need to remove sample size. In fact, let's take a risk overlay, for example. Imagine you have some kind of overlay that tells you you need to cut your risk. Um, if you sliced all of your trades by the same amount, I mean, it could be just like, the market's going bad, and this is where I would have started to cut. You could think of COVID crisis or something, and a lot of the systematic guys did step in if they knew this type of volatility was exploding, or they knew that the correlations were starting to get to one and it was getting very choppy. You could reduce position size across the board, but in fact you would have maintained the same amount of trade number. So the sample size and the outlier is maintained the same. And I think that that's a very interesting property, um, that gets to be maintained, where if you have a filter that's cutting trades but not modulating the position size, then you have affected your sample size by turning something to zero. And I think that's maybe something that's not necessarily considered that often.
What did you turn to zero?
Oh, I mean, like, you don't want to turn something to zero. So if you have a filter, like say, I'm not going to take this trade because of XYZ situation, your position size is zero, which means you didn't take the trade. But if you have like a risk management overlay where you've cut your position in half, you still took the trade. It still goes in your trade record. It still will have that outlier profile. But maybe you have, instead of 2 units, you have 1 unit. And so you still get to maintain the total sample size. But if you used a filter instead, you wouldn't have.
Now, this is the type of overlay that I've used my entire career because I was taught to do this. And so it's just perfect because it allows you to keep following these rules, which is so critical. And, I think you can justify almost anything um, under the philosophy of staying in the game and not and staying alive. And we shouldn't rely upon these systems to in a religious way that they're always going to work, or if we don't follow them, we're somewhat less of a human and less of a good trend follower. So I think this is something I've always done and thought was just great. I do think early in my career, I frequently used this type of overlay because I was trading too large, and I think you can kind of prove that if you're gonna if the more you implement something like this, the less money you'll make. You might as well just trade smaller to get to this optimum level either mathematically or in your own personality, to where you don't have to make these cutbacks very often. But I was, trading large, greedy, and it was just almost a weekly or monthly something that I would do. But I think infrequently, this is like the best rule, the best risk overlay ever.
Jerry, I think that this is a question for you. Do you systematize it, or you do it by feeling like, you can't sleep and your position is too high, and then that's when you cut? Or is there actually some kind of back tested thing on top of it?
Well, I don't think the back test is going to improve it necessarily, especially if you do it infrequently, which you sort of should. You shouldn't continue to override your system and these rules. You should just trade smaller. Um, but I think having it as a rule is fine. I'm not really, if it's such a low sample size, historically over the years when I've done it using a rule, we would, the turtle rule was, if you have a 10% drawdown, you reduce your positions and your future trades by 20%. So you're making this cutback across the board on positions and future trades twice as fast or twice as large as your drawdown. And this is some sort of risk of ruin formula that they came up with that makes it almost impossible for you to blow up. Now, there never was much of a explanation as to when do you go back to your full size. That was sort of winging it, I think. I think the whole thing is kind of winging it. I felt really uncomfortable during COVID, and then I was losing lots of money, so I cut back. I think the key is, however you're going to do it, just try to make it infrequent, so it doesn't overwhelm the edge you have in your systematic core strategy.
No, I think that's actually interesting, because I've done the same. Um, and I've had exactly the same question. When do I turn this thing back on? And in fact, some of the things, I mean, I've done it exactly once in maybe 3 years or so. I just left it there. I couldn't determine, even if your, equity curve is making all time highs, like, should I go back to that point? Like, what is the reason to do that? I cut back for a reason, and there could be a situation whereby we get to that risk level again, and I should cut back. And then it was just, I'm trading too big, and maybe my trades right now, or normally it's okay, but if we get into that 10% outlier zone, then things go bananas, and I shouldn't let that overwhelm the system. And you know, it also works in continuous space, not just trade space as well, which is also very interesting, because some of the things, turning it off and on, but also like modulating things with this, kind of applies both in the portfolio context and the trade context. Which is, sometimes we have these discussions: are you managing things by trade, or you're managing things in a portfolio way? And this is one of those tools that works for everyone, which I find very cool.
I'm wondering whether we should break it into two forms of systematic overlay: that which is a risk management measure versus that which is attempting to improve the performance. And I'm wondering whether any such overlay that attempts to improve performance is probably something we don't want to do, because that probably would legitimately influence the sample size, but certainly something as a risk management overlay to stay in the game, to basically as a defensive measure, just in case your systems have been sort of compromised. Maybe we should think of it that way. I'm not sure.
Oh, definitely. I think if you're trying to, I think this is one of the complaints I have with vol targeting, is that it's sold as something, oh, it's just for risk control, because the markets are more volatile now, so let's scale back. But what it actually is very effective at sometimes is just making more money, because the volatility heats up and the trends, you're able to get out and the trends don't continue. And that's a good bit of what happened, I think, in the early 2000s. is that it was mostly beneficial as some sort of take profit method, because the long-term trend following, which was deemed to be necessary, gave back too much profit. And so I definitely would separate those two. Heck, if it's for making money and for making the system more profitable, write a rule for it, make sure it's robust, it has a good sample size. Yeah, you're done. The overlay, by definition, is low sample size, not part of the core system, hopefully unnecessary, and the motives are purely defensive.
Of course, I'm going to flip this whole thing on its head and say, what if we use it offensively? um, okay, let's imagine we had an overlay that did the opposite of what this risk management thing did. I'm thinking of it as like a card counter. Um, there are some situations where the count is high, and we want to maximize our bets, and there's other times where we can detect that things are not normal, or we don't really want to be as much in the market. If you are only changing your position size, so say like your standard size is 2 units, you drop to 1 or you go up to 3 depending on that, is that vol targeting? I mean, what if vol is not the thing you're using? You keep your sample size, but you have this extra thing on top. I don't know. I think it would follow that the opposite would work. You know.
Yeah, I see where you're coming from, but it's really contingent on whether your models apply this thing called market timing. And I certainly am not confident in my ability to detect regimes and to identify when conditions are necessary to change a system. I tend to, in this sort of non-predictive mindset of mine, I just assume no matter what the market's throwing at me, any condition is possible. So I'm very loath to make decisions on the fly using a smaller sample based on a current regime. I'm not confident about that at all.
I guess the question is, what constitutes risk management, and would you call profit management achieving superior returns by having fewer and less shallow losses, or would you call that profit management and trying to improve your equity curve? Because I think we can be confused by semantics. I mean, anything that avoids getting caught on the wrong side of the market, obviously knowing too well that I can't forecast, and I can't make predictions. But so anything that helps me, effectively managing the pain, taking a little bit of that sting out of the tail, to me is successful risk management. Whether or not it's designed to improve the smoothness of my equity curve, or leads to a smoother equity curve, is less of a consideration. I would still like to do it, and so that's why I'm perhaps the guy that just gets involved in more or most of these overlay types risk management. But I don't do it with the goal of making my equity curve smoother. I know that by taking less impactful hits will yield better performance overall. So that's what I'm trying to do, and that's what I'm using the overlays for.
Yeah, I view my process of system development as a rigorous process that needs to meet all of these conditions: long-term robustness. There's an adaptable component in it. All of these things. So I do that exercise. And once I've done that exercise, I'm confident in the systems or the models that I've developed, so that if I then find that I'm entering market conditions that I haven't seen before, um, I possibly would consider defending that stance by reducing my position size further to reduce my adverse risk. But I certainly wouldn't attempt to change unless I redid the entire exercise. I'm more than happy to redo the entire exercise and then start afresh with a robust, sample size and a new sort of system methodology. when I've encountered new conditions I haven't seen before. But I'm certainly not prepared to make that decision based on, a week's worth or a month's worth or 2 months worth of data, because that level of granularity in that decision making is so small in relation to all of the other rules I've developed in my process through my robust method. It's sort of it runs totally counter to my whole systematic workflow process in developing these models.
And I think that that's interesting because it for sure adds another layer of complexity, right? Because now you have two layers of system. You have your core, and then you have your overlay. And obviously, we spend most of our time developing the core, and that's how we run our businesses. Um, but I think the uncertainty can be higher, and the reason that is because you're only attenuating the signal. You're modulating it. If you were trading 10 contracts, or I don't know, unit 10, I don't want to name size, but like you could do 1/10 of it, two tenths of it, 50% of it. You can really change how it affects it. And obviously, if it gets so small, then why would you be using it at all? Um, so there is more room for error, as in like you could be wrong and it doesn't punish you as much, because then like you said, making a rule or making a pure strategy or a pure filter that would turn everything off. And I think that applies both to the risk management side, but also to like the profit seeking side, such that you would be taking even an incremental 20% more position if the environment was very conducive to your strategies.
Actually, I'll tell you what I would do. If, for instance, I made a decision to reduce my position size as a defensive measure to stay in the game, once I'd made that decision, we've all talked about, well, when do you go back to normal? It's a bit like, entering a hedge position simply to defensively protect yourself. But then the real problem arises with, well, when do you take the hedge off? And that's always the problem I've faced, in that once you sort of get yourself into this position, it's sort of like you're then once again faced with this timing problem, which I think is for my particular method, or this method I approach. I always avoid any form of timing or regime determination. But what I would do, if for instance I did have to take a defensive measure to reduce my position size, I would then redo my entire workflow process, redo my models based on that new data that has forced me into that position where I've had to take that defensive measure, because that means that my history or my sample size has not encountered that particular data set before, and therefore let's do the entire process again, redo my models, and once that's done, I'll start afresh. I'll then basically turn all my models off and implement my new models based on that sort of rigorous workflow process. So it's not really an overlay, as far as it's a complete replacement as opposed to an overlay, if that makes sense.
Yeah, so I don't respect the back test that much. So a lot of bad things that I've never seen before are going to happen in the future. And so I'm mainly just looking at my trade stats, my average win, my average loss, and what's going on today, or no matter how bad it gets, that's probably not going to shake me or change my back test results very much. So I'm not going to worry too much about that, changing my system or worried about my parameters. But I do think I've come up with a much better solution for myself in this regard of when do you go back to trading, and when do you change your trade level once again once the carnage is over? And so it's sort of like, if I start with $1 million, then I'm going to trade it as a million, and then if it gets up to 1,300,000, I'm going to move my trade level up slowly and make it sort of dependent upon the close trade equity. So maybe if I close out all those positions at 1,100,000, that's my new trade level. So if I start having problems around that area where I'm losing too much money and I'm back to a million, I'll just say to myself, I chose the wrong trade level. I moved it up too quickly. It was went from 1 million to 1.3 with open trade, back to 1.1 because of all the closed out trades. So I'm going to move it back to a million, and then there is my trade level. And then I'll follow that same procedure again. The next time I run it up to 1.4 million, I close out a bunch of winning trades. Now I'm at 1.2 million. That's my new trade level, 1.2 million, because that's sort of my closed trade equity or whatever. It's an equity that's not subject to a lot of open trade equity, let's say. So this I find to be much more objective and able to implement versus this idea of I've got to get back to my original trade level or my original unit size. I made this 20% cutback. When am I going to put this 20% back on? This anxiety, I just never really enjoyed it. So I really am happy that I came up with that sort of process.
I
And it's
like it,
all,
Jerry. It's sort of like a let's sleep well at night method, which you basically adjust your settings so that you're sleeping well at night each night. I like that.
well, not to get off subject, but I'm on my way to 200 markets now. And I'm trading so small to begin with overall.
Well
And
done. Well done.
now 200 markets, each individual trade is so inconsequential that I really do sleep a lot better, let's say.
You're not going to have much to do in 2022 if you're looking for new markets to add. You're already added 200.
Yeah, I think that that's interesting solution. I have been trying to systematize that. I think we all have that intuition as fund managers to understand when it's too much, both for ourselves and our clients. Uh, but I feel like what makes me feel uncomfortable. Like, what is the trigger point that today is the day I feel like really uncomfortable with my positions, and then like working backwards from there. Yeah, it makes sense, and that is I have done that before. Um, but would there be a way to make that more stable and to understand how that is affecting my trades and my equity curve? I know if you're only looking at trade stats, the trade stats will stay the same because you are in fact taking the same trade, but it will affect the equity curve. And um, maybe that's where systematizing it so you could put it through a back test would be informative. It's not necessarily something where you're going to take the new equity curve and that is what you're going to take it as face value from the back test. But I think I don't know, because it happens so infrequently. um, if I did this thing for 10 more years or 20 more years or 30 more years, hopefully my career is that long, what the net difference between doing it and not doing it would be.
I just would take comfort in the fact that I'm not going to improve my system with random trades, with non-system trades. And although I like these cutback rules and this overlay, it is non-system. So I'm not too concerned about the back test. I've seen people do back test on the turtle systems with the overlay, with the cutback rule, and their conclusion was just trade smaller, you'll make more money. Yeah, of course, because you're going to do fewer non-system trades. So even if the back test told me, aha, these are perfect parameters, I've back tested 1,000 years, and this particular cutback and this percentage, when this particular thing happens, really seems to add value, I would just discount it totally, because I'm just it's a philosophical thing that transcends any back test.
I hear you, Jerry, on that back test. But when I talk about a back test, I'm talking about something that I'm not using as a method to determine performance or future performance. I'm using it as a method to stress test my model. So what the back test inevitably says to me is, if I trade smaller and I can add more markets, my risk management, or I do not get into these adverse risk situations with my portfolio. So it's basically the back test is really a method that comes to the same conclusion as you are getting yourself in your philosophy. You know that by simply reducing a trade size to as small as you can go allows you to diversify across uncorrelated markets. So your search is therefore for uncorrelated markets, as many as you possibly can get, and that's basically what the backtest tells me as well, in as far as when I apply, say, 100 markets or even 150 markets or how many you like, with as small a position size as you like, and you're choosing these uncorrelated markets, so the backtest tells you for a start, well, over the history of 30 years, generally these markets have been uncorrelated, sufficiently uncorrelated to run a very extensive diversified portfolio. But for instance, if I did a backtest over highly correlated markets, say all stocks, I'd find that there was a risk weakness in that portfolio. So it would tell me something that I'd have to address as far as diversifying across different asset classes, that sort of stuff, with the backtest. So I'm using it as a method of basically to validate the philosophy of what I'm seeking to do with my method. So that's where I do get a lot of confidence that my backtest is basically empirically validating the philosophical assumptions of my trend following mantra: cutting losses short, letting profits run, maximum diversification, small bet size. One, an initial stop, a trailing stop, and an entry. That's it. So that's all validated by that backtest. It's just that empirical validation of the philosophy. And once I've got that in place, then I can use that backtest as a guide to say, well, okay, let's look at additional markets to add. How uncorrelated are they? And I'll throw them into the backtest, and it will tell me that at least over the history they are less correlated than other markets. So I'll say yes, I'll use those ones. So it's just a method for me to validate what my philosophy is telling me.
I understand what Richard and Jerry are trying to do in terms of these overlays. I guess the question I have when I think about those overlays is for the group or those among the group like me who think in terms of more integrated risk management, because in theory I shouldn't need to have this overlay in place, given that every day I turn up at the starting blocks of a day with a fixed amount of capital that I have to deploy in order to achieve a certain performance over a certain horizon. So I don't vol target given my performance. Has my performance been up until today, and then I adjust that in terms of a volatility target that I have written some sort of docs or some sort of mandate. But I rather try to have a performance that fits within a volatility range over a period of time, and the two things are different. I mean, they sound like they're the same, but they're not. And so this overlay, in my opinion, is already inbuilt in my risk management. And those of us that do this, shouldn't need a further overlay. So if I'm losing a lot of money, like what happened on Black Friday, I dropped a lot of money in one day. Then I inevitably traded smaller the following day because everything sort of told me, look, your signals are getting a bit more confused. If you're trading this big, given the market volatility that we've seen, or the volatility that happened in the market, is going to make you lose money faster. So just cut everything. But I haven't had another overlay that said, oh, because yesterday I had which happened, there was the loss of my system history, then cut everything that you get out of the model by another half or something like that. So the question I have is, those of us who have a more sort of integrated and sort of continuous approach to risk and to signaling and to capital and trade sizing, do we really need a further overlay on top of it?
I'm not sure you do. I think that that's where the systematic part versus the discretionary part comes in. Because is my understanding of what you're doing. You have that integrated and you're running the portfolio method and you are satisfied with those situations. and it is affecting you on the times where things are going sour. So, I mean, in maybe the 0.0001% case where whatever you have programmed in doesn't take care of the risk management, you may need to step in maybe once in a 10-year situation. But I don't think you would need that because of how the architecture of your process is built.
Yeah, mine was a bit of a cheeky and rhetorical question, but yes, I mean, I agree with you. I haven't had another thing, as you said, when something happens that my system sort of doesn't understand or doesn't know, I consider that as sort of a shortcoming of my philosophy rather than a bug or one less feature that I should add to my system. So what happened on Black Friday was something that was very painful, but it, no matter how I thought about the system, I couldn't pre-program it. It was a very fast and sort of somewhat deep margin call that happened in a day, because the following Monday everything was back to normal again. So it's very hard um, to manage that. Even if I had a volatility, pure volatility overlay, I wouldn't have had the chance of gamma scalp that. So I took it on the chin like most of us and then moved on.
It's interesting. Since Black Friday, I've totally revisited my portfolio. My models have all changed now, so I've now incorporated that feature of Black Monday or Black Friday, and also back to that March 2020 event. But because I do annually refresh my portfolios, uh, this sort of new information, this new data we've received, actually does force me to adapt my models based on that new data received. So there is a sort of small Bayesian component in there. When you do get this additional data set, your models naturally adjust accordingly. Now, no, Jerry might not like that, but really the process I'm using is basically, just redoing my workflow process over a vast sample size, basically just refreshing my models on sort of an annual basis with a very slow sort of adapting component to it. And now I can sleep at night thinking that, well, at least if these events do play out with these highly correlated sort of impacts, the measures now that are sort of integrated in my portfolio, hopefully have addressed those situations, and the impact of them will be less in the future.
I like everything you say, Richard. I mean, when I've had these periods, I did not have those thoughts. So I had the thought of, okay, let's trade a bit smaller. Universal maximum risk budget maybe needs to decrease. That's what I said in February of 2020. And then let's continue to find more markets. And maybe I'm trading too many stocks, so let's reduce that sector, or too many bonds, let's reduce that sector. But no, the systems are fine. And then, when you have these drawdowns in big profitable trades, there's nothing going on here. There is no loss. There is nothing black about it. It's just what you're paid to do, is to take these small losses and to let those profits run and sit with that volatility. And that volatility that you don't want to sit with is negative volatilities, down days. And so what if they all happen at the same time? So what if it goes to one? They're hugely profitable trades. And if there was something unique about it, the computer would say as much. It would say, hey, when you see all of this go to one, when you see all this negativity, uh, you're going to lose a lot of money, and it's going to impact the back test. And it's going to say to you, don't do that. But it doesn't say that. It says, hang in there. Um, Become even longer term, possibly, and put more of this open profit at risk. I'm not saying that's the lesson of Black Friday, because there is no lesson. But once again, the faith that we put into these long-term models that let profits run and don't obsess over the volatility of those open profits was rewarded, and it's confirmed that in the long run, this is the way to handle things. Although I am in the camp with Bruno that I think that the majority of my discretionary low sample size type trades would be to take profits off the table with a big, huge trade, and that has gotten very volatile. I'm not against that at all. But like he said, it has nothing to do with smoothing out my returns. I'm greedy. I don't want to give back all the Tesla profit. I want to book some of that.
I came to a happy place, Jerry, where I've realised why it affected me and it didn't affect you, and where I've come to the conclusion is that you are much more diversified than I am. Now, I'm in this situation as a small retail trader with a small finite capital amount that my level of diversification is far lower than yours. And so the impact of that Black Friday event probably was far lower to your overall portfolio than it was certainly to mine. It certainly gave me cause for concern. And when I redid my workflow process, lo and behold, I was able to increase my diversification further. So I think that there are nuances here that also relate to the level of capital you're trading and the degree of diversification you have. So, you could be scratching your head saying, why is Richard saying that? And then I could be scratching my head saying, why is Jerry saying that? And then you realise, well, it's because Jerry is far more diversified, much more diversified than I can ever be.
Oh, exactly. That level of diversification, the level of maximum risk budget, that is so crucial to being able to just be cavalier and say, oh, don't worry about this volatility. Yeah, I'm not worried about it because I trade a lot of markets and a lot of capital, but I'm afraid. I'm chicken. I don't want to trade. I don't want to risk too much. Another thing that popped up earlier that I wanted to mention is that in going through all of the risk measures and overlays, it's very difficult to do if your initial choice of leverage and risk is too much. This is the most critical thing for traders to. The first step is, what is my risk budget? How many units can I possibly have on? If everything moves twice as much as normal in one day, how much will that hurt me? And if it's uncomfortable, that's purely discretion on your part. You can live with a certain amount of risk, a daily risk. It's going to come. You should expect it. And it's easy to anticipate what it might be and then double that, and you might be close to it. But to try a maneuver, a quick maneuver, and a quick thing to do to overcome the taking on too much leverage and too much risk, you can't. It's not going to be reliable. So you're not going to be fast enough, and situations will change where your rule won't be good enough to overcome a new set of circumstances. So it's critically important to basically trade small and small enough to where you won't allow your emotions and your budget and your finances to encourage you and force you into doing non-system cutbacks and non-system trades.
Spot on, Jerry.
If you don't mind my asking, Richard, how did you adapt in the workflow? What changed, or what data was incorporated, and what was that process like?
Each year, I annually revisit and totally refresh my portfolio. So, with an additional year of data, I can actually find that there are certain markets that I can now include that weren't in my prior portfolio because I have a sufficient data. So, one of the key things I look for is liquidity, and I'm looking also for sufficient data to make a validated assessment of their trend following. When I apply my trend following models, that there is a sufficient degree of data there to validate them. So, with that additional years of data, I've been able to increase my level of diversification. And when you rerun that backtest with that adjusted portfolio over events such as Black Friday and March 2020, when a lot of the markets became super correlated, um, basically the total refresh of the portfolio, which incorporates these different processes like robustness tests over long-term data sets, multi-market potential, this recency test over a 10-year look back. When I apply all of them, it reconfigures, readjusts the entire portfolio, adds new markets in, and then I can be confident that I've now I've got a portfolio that has incorporated this new data history. So I'm happy that it's progressively, slowly adjusting to new environments. And it's just my confidence, my workflow process, Derek. That's all I can really say.
There's actually a nice video on YouTube about Richard's trade selection process, and I actually understood a lot of his workflow by watching that video. So I'm not trying to explain other people's work, but what I think Richard achieved by rerunning his portfolios. I mean, he's quite visual in his approach. So he incorporated all this new data in his backtest and saw that all these curves that he's monitoring, all these equity curves, because he always starts from standalone equity curves like revenue streams, had done something unusual over Black Friday. So he said, okay, I don't like those profiles. So he chucked them out of the tradables universe and got in some new instruments instead. And so that's why the portfolio changed, because Richard does some what I sort of called light touch optimization. After he's selected by computer first and then visual inspection a number of curves, he just chucks them in Excel, I think, on some sort of
Yeah,
optimizer,
totally,
and
Bruno.
then
It's
does
called a
that.
map to market function, where you just visually map to market your equity curve against your market data, and it allows you to chuck out ones that you feel are unhappy or at least compromising the risk in the portfolio.
Yeah, and that's brilliant. I mean, I really like. I mean, obviously, I have a completely different philosophy, so I wouldn't know how to do it. But I quite liked his approach because he can then say, okay, I like this profile, I don't like this profile, and then he does all of that before he feeds it to an optimizer. So his process is robust in that because once he gets to optimization, he's already filtered out all the things he doesn't want, which I don't know how to do with my approach, for example.
I'm definitely going to have to check that out.
I wouldn't lose any sleep about it, Derek. But just in saying so, I am a very visual guy, so I can't really work with statistics, but visually I can sort of work quite powerfully with data.
I think that just speaks to, sticking to our strengths. And I'm trying to kind of put together um, how these things work together, the adaptive part of our systems, the Bayesian nature of what we're doing. And the interesting thing I think that, or the takeaway that I took from what Richard just said was, we all have this problem. How we address it is different. But we're just attacking the same thing from different angles. If you have a Black Friday event and you cut your position size, or you have a COVID thing and you address it, or you do what Richard did and just rerun your portfolios and remove kind of the bad effects that you didn't want to see, such that if it did happen again in the future, Richard is prepared. Uh, you know that is achieving the same goal. Now, I think what would be interesting would be to compare Richard's new portfolio with an old one where he was, doing this kind of discretionary overlay again, because now I think Richard's solution brings it into the systematic way. And Bruno's has that as well, while, and I'm over here being a Neanderthal still, doing it the other way around. Um, so I think that's quite interesting, integrating it into different parts of your portfolio optimization and construction.
Just a interesting note is that I'm a firm believer in that the worst time to be turning off your system is when it's in drawdown, because that inevitably introduces loss into your portfolio. So I'm I sort of almost adopt a sort of an evolutionary perspective with my portfolio, where my decision to turn off or turn off my systems is not made on performance or on a particular regime. It's only done at annual intervals, where my workflow process totally refreshes my portfolio. So what that means is that even performing algorithms are replaced, so that my decision, I don't ever have to worry about, oh, is this system performing well or not? I never get that question arising, because I just know at the end of the 12 months, when I must let these systems run for 12 months as they've been designed. And then at that 12-month period, when I refresh everything, it's a total revisit, a total refresh of my entire suite of algorithms. So that therefore it gets rid of any nagging feeling in my head about, oh, should I be turning this algorithm off or on or whatever, or how well is it performing? You know, all of those questions. I never have that question, because my process actually totally refreshes it. And it's a bit like how I view survival of a species. Like, you know, we often talk about the cockroaches and how they're such a robust species, but what you find in the evolutionary pathway is that the species or the algorithms, the species or algorithms that treat them the same way, the ones that survive are not those that have, come back from a drawdown. They're the new species that are suddenly adapted to a new environment. So that's the way I review my refreshing of my portfolio systems. It's saying, we've got this environment or this landscape of evolution for the past 30 years. We've got this additional year's data now, which has told us some more information. So what are the most successful species now that can inhabit this new regime with all of this history at its disposal? What are those most robust species that are able to survive that entire 30-year period and not suffer these risk weaknesses? So Jerry and I are very fortunate in that we don't have to worry about the profit side at all. We let our profits run. So the profit is not a problem for us. All we've got to do is manage the risk weakness of our portfolio. It's the risk events that are important. So if we manage our risk and we don't worry about our profits, because that's the natural outcome of our open-ended solutions with our algorithms or our method, it's just just something we've just got to manage the risk weakness at all times.
You know, I would this process, I mean, talking about what Richard is doing and thinking about eliminating I don't know what exactly it was, eliminating the parts you didn't like. Could you do the opposite again? You know, I'm thinking to myself, okay, if this process works, could you maximize the things that you really like, to pump up the returns? Does that still work with your optimization process?
No, it doesn't for me, because I'm really focused on these outliers, which by definition are non-predictable. So I can't tell anything about them. So the open-ended nature of my algorithms capture any outlier. I'm confident in the system design of every single algorithm I've got, is that when it jumps on board a trend and that trend it becomes an outlier, I'll still be riding it over the majority of that outlier with my different systems. So I just can't, I cannot do any sort of profit improvements with my systems. Everything I do is risk management. That's it.
I actually think that you can do, Derek, what you were saying. I certainly hope I can. But again, there's a clear difference between looking at each individual trade or looking at the portfolio. I believe that I can do that at portfolio level. So there are effectively the optimization I run. I like to call it as a two-axis optimization. First of all, you inspect and exploit different correlation structure between your subsystems, your underlying different either signals or speed at which you run your signals and monitor your signals, and then you do it at portfolio level. But the goal is, if you have a right um, you know correlation or dependency structure. Correlation is probably the wrong word, but if you describe dependencies in your portfolio right, and you have a good approach to optimization, I think you can do exactly what you were saying. So upweight the good features of your return streams and downweight the ones that you don't like, so you can achieve the best possible return within a target that you set. I set it in terms of overall volatility over a certain period of time, because that maps, obviously there's a one-to-one mapping between risk and return. and that's how it's done. I mean, if there was an explicit way of target returns and be precise about monitoring returns, I would do it directly. But I found that it's easier to model, monitor, and follow volatility or deviation from a target than the target itself. So that's why volatility targeting comes into place in my world. But it's all to do what you were describing. So optimize, I think the other week I talked about maximizing my opportunity set at every possible state of the market, and that's what I'm trying to do. So yes, I would like to say yes to your question.
It's not something I've actually tried, to be honest, to maximize. I think I've kept it quite simple in this regard, doing kind of the standard processes for strategy development. But I do like this conversation going in the direction of maximizing opportunities, um, because I think that that's something that we should do. And as much as surviving can make you the hero is something I learned kind of this year. Other people will fall apart. The idea of the cockroach and all that. But that doesn't mean that cockroaches aren't really good at seeking out every opportunity to get every morsel of crumb that is left from your dinner table or the garbage or whatever. And it does deserve some attention, but I do think it's harder. Because of what we need to identify for those target rich environments, so to say. Um, we intuitively feel the risk component because it's directly affecting our P&L. But I think this goes back to what Rich was saying, that like, okay, how do you identify a target rich environment? Is that a regime detection, or Bruno is uplifting the features? I think they're actually two different things. If I think about it in Bruno's methodology, you imagine these features, you have a portfolio of these features or factors or whatever. You're timing your factors, or you're scaling up your factors as they do well, or these return streams in your portfolio. Uh, while on say Richard's regime detection side, or maybe in like the kind of going back to this kind of overlay, maybe the macro environment just happens to be good for you, or the say like the skewness environment is like really high or something. I'm just making things up. Then you would be able to detect that, but they're doing two different things that would be maximizing your return. And maybe even if you were able to do that, you would reduce your risk, because um, you would be maximizing your gain. So like you would have more distance to draw down. So like having net higher realized returns at the end of the day, I mean, makes drawdowns much easier to take in the future. If that makes sense. Like it helps your compounding.
It's very interesting, Derek, because the more I break this down in my world, there, you certainly can find this opportunity, but that opportunity is found by reducing your bet size and diversifying as wide as you possibly can go. And whilst that's not using any data, well, what it's doing is it's this hunt for outliers. It's saying that the further or the wider you can diversify, the more chance you have of targeting these outliers, which therefore sort of improves your long-term net wealth. But in doing so, do not expect a cash flow solution. Do not expect a regular, return stream. Expect a volatile profile. So this opportunity, how do we improve our models? Well, I know how to improve my models just by following that approach. But I think the problem lies in, the more I think about it, the more it is that Bruno, yourself, and me are probably fighting with this inability to widely diversify, probably because of our capital constraints or whatever, and therefore we're forced into a mentality where we're trying to look at other means to improve our performance. But really, probably the ultimate secret lies in this ability to just reduce your bet size and diversify as widely as you can go. It might be as simple as that.
Yeah, I mean, I do think that obviously Jerry's capital is higher than mine, so that might pose um, differences there. But I actually, and especially listening to the second part of your, Jerry, Richard, Mark, Rob, Moritz, and Neil's podcast, I think it was very clear the difference that in approach that we have. There's some of us who are more focused on portfolios, and some of us who are more focused on the outcome of trades. So that drives your attitude towards different things. I mean, you guys, Richard and Jerry, are very, very serious about two things: skewness and maximizing performance per trade. So everything sort of falls back from there, falls into place from there. I am more concerned in creating different diversified revenue streams and put them into a portfolio through which I want to achieve compounding. So I have to sort of manage my downside and my volatility drawdowns. It's a slightly different game. Of course, we do the same thing. Of course, we all like trends, but I don't. Pushed by listening to you and Jerry in particular, I toyed around with setting up a very simple regime detection model, and just by looking at price, and I can't. It's a very simple and very crude thing, but it's good that it is Bayesian and it has all the properties that I like. So my forecasts and my regime probabilities are fairly well. They're fairly robust, and they vary with time, and they have the properties that I like, but they're not very persistent. And my problem is, even if I was able to, for example, I looked at a lot of, Jerry's positions. I looked at Moderna, I looked at Tesla, I looked at all these things. Yes, I mean, you can, through this very simple model, you can see when things become outliers. But guess what? They stay, in that outlier state for about, let's say a couple of weeks, and then they fall back into random walk for a bit longer, and then go back again, and on and on and on. So it's as Jerry says, to capture all these outliers to the full, you have to be invested for months. And whereas I need to sort of my philosophy forces me to deploy capital every day and sort of question every position every day. Maybe this is my mistake. Maybe I should just let the portfolios gel and sit a little bit longer rather than trying to kind of change configurations every day, which I don't, because obviously I have some other things that prevent me from doing. But in principle, I sort of question all ability, all trades merits and validity at the beginning of each day. Maybe this is a grave mistake, logic wise. I don't know.
I don't think it is, Bruno. I think it's that you and me to a degree, and probably Derek, we're forced into trading the bulk of the market distribution of returns. Jerry's in a fortunate position with his high levels of capital that he can really focus on that tail of the distribution. So he's basically, with his long look backs and his very wide diversification, he's very selective in when he sort of gets interested in a particular trending opportunity or an outlier. But we're not so fortunate, so therefore we've got to try and improve our models by sort of venturing more into degrees of convergence and areas more within the bulk of the distribution of market returns. So these methods we're talking about, the volatility target, I can see where you're coming from, because I can see how people that do not have that level of diversification are sort of forced into that box where they've got to start looking at market regimes. They've got to start looking at sort of highly quantitative methods to assess, different market regimes, and put a bit of mean reversion into their techniques and those sort of things. So it's really a case of trying to do the best you can with your limited resources that you have at your disposal. But all I'd say is that, well, maybe the game is, only sort of, build your capital till you can play like the big boys, and wait until you can be sufficiently diversified. If you really want to build your wealth, participate with these big, trend following funds, these classic trend followers, rather than maybe doing it yourself. That's sort of the conclusion I'm coming to a degree.
I mean, I'm definitely hit up by constraints. Definitely on the smaller side of things, and on the newer side of things, um, I can see how, like, being self-reflective on this, not having the same infrastructure, not having the same amount of capital and not having probably the leniency in mandate and clients is um, definitely a big difference for why I'm targeting this thing. I think that's a very good point and something I have to reflect on in the future. The idea that we will get there one day, I don't know. I think Jerry in himself is an outlier, to be honest. Uh, I
I'm
don't know how.
laughing.
Yeah, I don't know how to approach it though. I mean, the problem needs to be solved like today with what I've got. We have to be scrappy um, guys running our books, doing the best that we can, and we can take those tools. But I don't think that maybe my say the reason why behind is because I'm constrained. I think that also means that we do need to get creative. And I mean, look, this is a room of smart people. I do believe that we could potentially discover something that would help, or at least like we do today, is throw around ideas that have worked for each other, such that it gives more perspective. And I do get a lot of value out of that. It's just, I think it kind of hurts a bit. I have to, be humble in the fact that I have to do that for that reason, Richard.
No, I understand, mate.
I just wanted to comment on what Bruno said. So I agree that wholeheartedly that you hit the nail on the head. It's one group who, and I'm sympathetic. I mean, I understand, and I'm not. I talk a good game, but in practice, I'm much more flexible. So it's one group that's interested in the portfolio, today's performance, this week, this month, Black Friday's performance, and then another group who really is obsessed with the trades, but for good reason. And that we're obsessed with the trades because in order to get that backtest performance, we feel in the future, we've got to follow these rules, these simple rules with lots of sample size, one entry, one exit, and a stop loss in order to get what we've seen or even get close to what we've seen in this backtest. So out of fear, we don't want to be too concerned about today's performance, the equity curve. We are emotionally, but we know that we don't want to blow it. We've gotten onto something that's amazing, it's wonderful, it's great. Train yourself to not obsess over these factors that most normal people would. And then the way to do that is keep repeating that to yourself, live with it, watch the good performance come, watch what happens after those drawdowns. They all get forgotten, and trade small. Do you fine tune it to a level to where you can make that kind of money that you've seen that was made by following these rules in a very strict way?
That's exactly right, Jerry. And that's how you have a 30 to 40 year track record. It's as simple as that.
I was listening to what Jerry said, and I think that it brings up a good point, and it's maybe one of the reasons that it keeps working is that you have to tell yourself this so that you can keep on keeping on, if that makes sense, because it's hard, and all of those things, that we're talking about is to make it easier on ourselves psychologically. In the end, we're the people pulling the trigger, pulling that lever to reduce size or whatever. It's to make us more comfortable, and we may tell ourselves that it's for the clients and all this and to protect the risk management, but in the end, it's us who needs to sleep with that risk at night, right? That's why we're hired. And that is what keeps this thing persistent. It's because it's hard, not that it can be simple, but it's hard, that keeps it going.
That's right. And I think if you hired someone from one of these large CTAs and you said, hey, you're in charge, I'm going to pay you a lot of money, and I want you to forget all of this fall targeting. Just forget the equity curve. Just come up with the best systems, risk the right amount to where we don't blow up, we keep our capital, and don't even worry about volatility. I think for most of them, they'd say, I can't do it. I cannot do it. It's not that I intellectually alone came to this conclusion after business school and being a PhD that vol was very important. In my soul, I believe it's very important. And so I think to get yourself off of that drug is so difficult that vol is not necessarily all the time risk. I'm always walking around the house and my wife is like, "Who are you talking to?" I'm like, "I'm talking to myself." Yeah, because I'm encouraging myself. This Clubhouse and podcast have been invaluable. My trading has improved dramatically. My portfolio, my strategy has gone up just by listening and getting it out. And then after I get it out, I'm like critiquing it. Like, is this right? I don't know. But I feel like I've made great changes and philosophically become more tethered to what is true by having, being part of these conversations.
Likewise, Jerry, they're wonderful conversations. I really appreciate both tonight's with Derek and yours. It sort of gives a very wide purview of some of the issues we're facing. But as you say, I think probably we need to focus more and more in later episodes on the too much leverage. I think you hit the nail on the head. I think the vast amount of traders trade with far too high a leverage, and so their temptation to volatility target, etc., might be a symptom associated with simply trading with too much leverage.
I think it's good that we come full circle, because this goes exactly to what Jared was talking about at the beginning. The solution is to just trade smaller. What if you just trade smaller and you are able to put as many markets as you can, but actually, like, your overall average volatility, if we want to call it that, of your portfolio is less. So what? Your trades will still be outliers. You'll still get good returns on your money, and you won't blow up, and you can compound, and it will be a lot longer road to hoe, but maybe that's just what you need to do. And then, talking about, building up and having clients and all that, you just reduce it to a point where that they can handle it. you know so what if you only make 1/10 the amount of, say, that others are making? People with higher targets or bigger position sizes matter. You still have the same profile. Maybe that fits what your clients want. It doesn't matter. They could lever you up for all you know. I think that is very, it's kind of the simplest solution, and it does solve this problem of, you don't need the risk overlay if you're trading small enough. It will fit into Bruno's idea that, it's integrated into the whole portfolio. Why? Yeah, because I cut off, the ability to that to happen in the first place. And then it also fits in the trade size thing. I'm able to trade more markets, or I can trade more entries or more systems to be more diversified because I have smaller original unit sizes.
That is so spot on, Derek, because if you scale down your bet sizes to as small as you can possibly go, your losses are as small as they can possibly go. The outliers are still, relatively the same sort of degree of magnitude greater than your losses. So you get all of the benefits of these outliers still, no matter how small you go. But the good thing is that your losses, your drawdowns, everything of your risk is minimized. So once you scale down to as small as you can go, and you just continue to diversify, but really the key is to focus on diversifying on uncorrelated return streams, then isn't that the solution?
No, I think it is.
Yeah, I think it is. This the return versus risk ratio only goes so far in human brain. You know, we like that. We want it to be. We want our stuff to be more efficient, but at some level, it doesn't matter. At some level, 30% drawdown is too much, or 50, or 10, whatever it is. And so, yeah, it is the secret to being disciplined and staying in the game. And then with me, you see, um, I'm letting these profits run, and it's just shocking how this small little trade that I did a year ago has now become a giant trade. And so it's not all, easy if you're risking small amounts and trading really small, because without doing anything, Moderna becomes like 5 or 6 or 10 trades, you know. And so that's why you're like, okay, that's enough. I think I'll get rid of a quarter of my Moderna. It's still a huge trade, and but these sort of take profits need to occur after hundreds of, or 100 or 200 ATR profits, and so not very frequent. And what happens if you get out of a profit at 200 ATR profit? What's the possible negativity of that? Yeah, it's pretty small.
Yeah, it's pretty powerful, Jerry. Very, very powerful. Because once you've achieved that, you've broken the back of it all, and then you can sleep well at night. And it's a solution.
All right, guys, I think we'll leave it there because that really does tie up this entire conversation in a nice, neat bow. So thank you guys for joining me, and everyone, remember, I'm sure Jerry has his clubhouse tomorrow, so see you guys there.
Many thanks, Derek. Thanks, guys. Bye.
Thank you all.
Thanks, Derek.
guys. Very interesting.